SMF Street Traders. I'm showing a $610 call on Google options right here. I've already given the pricing level out to the MMTs. So they already know what the price levels are that we're going to be looking at on this 610 call. They also, the new MMTs are learning that part of this particular type of contract was an earnings gap down here. These contracts were around $3 or so, but they gapped all the way up and they went to the high of $25.37. And what new MMTs are learning is that these were an inflated price area. They did stay inflated for quite a while. They were in a good trading range, the contract. So if you learn to buy the dip on a contract and sell into stuff like that, or buy at the bottom and sell back up, they're good for intraday. But they were extremely inflated up here, and now they're not. They're coming all the way back down. The public will hold them through here, then they'll gap down, then they'll gap down, then they'll gap down, and they will ride them down. That's what the public does. And on this particular trade, we had 10 of these contracts, and we had to take a stop market at $8.60. Well, that's almost $4 ago. And the thing about it is it warranted a stop, and we took it. But we've made a lot of money on Google, and we'll continue to do so moving forward throughout the year and going into next year. There isn't an, and so basically we got to the inflated area where the public holds them. Then they'll write them down, and we've given out prices, and we're going to look at the $610 call. We are also going to be doing the $600 call, which is this one right here. And the $600 call I'm going to put in this chart, and basically you can see at the highs $31 a contract, down to $9.50 by $9.70. The contracts closed at $19. They got a $10 haircut, and people rode them down. And not only did the public do that, new MMTs, if they were in it and before the earnings, because that's an earnings gap on the contract, would they have sold? No, because of their irrational exuberance, their greed, their lack of trade management, their lack of profit management, their and all the screwy thinking that goes along with it. And what they do is they'll hold it all the way down. They'll say, man, next time I would sell. They never do, because they don't understand what you're being taught here today. They don't understand that that's inflated. They don't understand that the market maker can short that thing down. They don't understand that this was inflated. They don't understand that they have washed the buyer out. They'll hold them down, and we're going to be buying this one. And I've already given the limit orders. As a matter of fact, I'm going to put the tape on pause, and I'm going to give the MMTs their limit orders to have for the options expiration. All right, I've given the prices out to the MMTs off of the tape. Today's date, 8:47 a.m. Pacific Standard Time. Today's date, 11/14 of 2010. Options expiration starts burning Monday on 11/15 and closes out on 11/20 of 210 for the November options expiration. And they expire every third week of the month of the major contract until they started writing these little weekly ones, and MMTs are not allowed to trade those because they steal the premium out. It's a sucker's trade. But the major contract every third Friday of every month is the one that they can trade. So basically, I'm going to move on over to the next contract, and I'm going to go to $590 call. That's still deep in the money. And you can see that they closed, the high was $27.50, the low was $16. The contract lost over $10 in value. But let me throw the 590 here on the chart, and you're going to find out here that when I draw the trend line up here, that these contracts were at $40 a contract. Once again, all of these contracts, mind you, were gaps. They were gaps from the earnings. And when I draw a horizontal trend line here, MMTs, What they have done is they pulled the contract below the price here. Check this out. This was the gap price on the earnings, okay, back on 10/15, and the low there was about $19.40. Okay, now MMTs, as you can clearly see, that was $40.20, but notice that the contract's at a lower price. Right there. It undercut it. It brought it down in here between that and the gap. On that time, they were $4.50. There's still a lot of room below this market for this expiration. The thing that's good about understanding the expiration is understanding the trend of the name, which is Google's the name. This is the options, though. However, over here, MMTs, you can see the support line that we're going to come down to, but we also know that during the expiration that they're taking all the premium out. Once they get all that premium out of here at wholesale price, there's going to be a big bounce. So 590 call is in play. We're coming down to a deflated short-term. They have taken out a lot of money. They were $40 up here. They closed at $17. Do the math. Sounds like a $23 haircut to me. We're going to be looking at trading it. And then I'm going to move on and we're going to do Apple. The thing that we're going to look at here is where that these calls are going to get wholesaled relative to the 15th and the 20th of November during that 5-day period, and where we get to get the big pop and the wholesale bid entry and then the retail exit. And the retail exit's always up here, selling to the public, because they will ride them down. That's what they like to do. Or unless they get a margin call and they're forced out of it. One of the two. So that's the 610 call that I've talked about. And the $600 call, which I have talked about. 600. The 610 call. What we are going to show people is this $610 put. That's got a $7 move there. And basically, let's see how deflated the put side of the market was. It's extremely deflated. These contracts were up here at $80 damn, and they took them all the way down here during that 4-day period, and the cutthroats got in. They got these things down here where they were only $1.85. Now look at them. They're 12.26 on the high. So this is deflated, and now they have inflated them back up in value. So as they go back up during the expiration week, if they go a little bit higher, what's going to happen is during this cycle, they're going to get inflated, they're going to roll over, and then the call side is going to go up. And that's what the 610 put looks like. See the price? $3.77. On the other hand, when you look at the call option, the 610 call here, it's $4.40. And it's quite a difference than the 610. Here's the call. It's like the 610 put that I just showed you at $3.77 is that they've exchanged places in the short term. And this is the side of the market now that we'll look at going. So that means that if Google closes above 610 during the week, if Google closes above 610, these will be zero. They have their move off of that 610 put. If that thing closes at $610 and 1 penny, these are zero and will expire worthless. So we're going to be looking at that change agent. And the same thing here on this put option, on the $600 put, is if they drive it down to the $5.90 strike price, well, this was up $4.50. The low was $1.65. The high was $7.10. And it wasn't in the money. Google hit 601.50 on the lows. And then we're going to find out if this, and these were deflated right in here, but they're starting to lever up a little bit. And we're going to watch and see how far they go up. and I will give the $600 put. I'm going to go off the tape. I'm going to conclude the tape, and then I'm going to give the MMT rises to.